The federal government has raised 501.02 billion naira from the bond market to kickstart the settlement of long-standing debt owed to power generation companies, a move aimed at easing over 6 trillion naira in liability choking Nigerian electricity sector. Welcome to Business Point, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okere. The federal government bond were mobilized through two 7-year bond tranches issued at 17.50%. The first is 300 billion naira series 1 tranche, a bond, while the second is 201.02 billion naira series 1 tranche bond B. Both instruments were issued by Embed Finance Company PLC, a special purpose vehicle of the Nigerian Bulk Electricity Trading PLC, and fully backed by the federal government under the Presidential Power Sector Debt Reduction Program. At the agreement signing ceremony in Lagos, the special advisor on energy to President Bola Ahmed Tinubu, Oluvenje, says the initiative was structured to clear verified payment areas and reset the electricity market on sustainable footing. She disclosed that outstanding receivable for electricity supply between February 2015 and March 2025 are being resolved through negotiated settlement. So far, 14 generation companies have executed full and final settlement agreement with a combined negotiated value of about 827 billion naira. Proceeds from the bond issuance, she explained, will be used to fund the first and second installment payment to participating Genco, estimated at 421.42 billion naira, representing roughly half of the total negotiated amount. The payment will be made through a combination of cash and promissory notes. The Minister of Finance and Coordinating Minister of the Economy, Wale Edu, represented by the Director General of Debt Management Office, Patience Oneha, noted that legacy debt in the power sector have hindered growth for years, adding that clearing them is central to ongoing reform. Embed Acting Managing Director Johnson Akinowo described the bond issuance as a major milestone expected to improve liquidity across the power value chain and unlock new investment generation. Generation companies have signed on the settlement include First Independent Power Limited, Geregu Power PLC, Ibom Power Company Limited, Mbom Limited, and Niger Delta Power Holdings companies. This issuance marks a critical step in stabilizing Nigeria's power sector by addressing legacy debt that have undermined liquidity and investors' confidence. While the 501 billion naira raise covers only about half of the negotiated settlement, it signals renewed government commitment to structural reform, with the success of program likely to deepen untimely payment and broader market reform. The Nigerian Deposit Insurance Corporation and the Economic and Financial Crime Commission are deepening collaboration to strengthen the investigation and prosecution of offenses that lead to the bank failure, while also improving the recovery of assets and outstanding debt linked to failed banks. The renewed partnership took center stage during a courtesy visit by the NDIC management, led by its Managing Director and Chief Executive, Thompson Oludari Sunday, to the EFCC Chairman Olanipekun Olukoyede in Abuja. During the engagement, the NDIC leadership emphasized that closer collaboration with the EFCC is critical to the effective liquidation of failed banks, particularly in tracing, recovering, and realizing assets. Proceeds from such recoveries are used to settle uninsured depositors and reduce losses to the financial system. The corporation noted that liquidation processes are often undermined by challenges such as asset stripping, diversion, and concealed by individuals linked to distressed institutions. Strengthening collaboration with the EFCC, especially in asset tracing and enforcement, was identified as key to overcoming these obstacles and ensuring accountability. Beyond liquidation, the partnership is also expected to boost efforts to combat banking fraud and other financial crimes, as well as ensure the prosecution of individuals whose action or negligence contributes to bank failures. The NDIC highlights its statutory responsibility in deposit insurance, banking supervision, distress resolution, and liquidation, stressing that this function are central to maintaining financial system stability and protect depositors' funds. On its part, the EFCC reaffirmed its commitment to working closely with NDIC in tackling financial crimes within the banking sector. The Commission acknowledged its long-standing relationship between both institutions, particularly in joint investigation, intelligence sharing, and capacity building. The EFCC disclosed that dedicated units include its bank fraud section already handled cases referred by the NDIC and encouraged the corporation to submit any pending cases for review of enhanced monitoring and timely prosecution. The Commission also highlighted the role of its fraud risk assessment and control departments in promoting compliance, sound risk management, and stronger internal control across financial institutions, pledging sustained collaboration with NDIC to safeguard the stability, integrity, and credibility of Nigerian banking system. The strengthened NDIC-EFCC collaboration signals a tougher stance against financial misconduct that leads to banks' failure. By focusing on asset recovery, prosecution, and preventive risk control, the partnership could help deter reckless practice in banking sector, improve depositors' confidence, as well as reinforce overall financial system stability, as well as provide enforcement action which remains consistent and timely. The National Pension Commission has approved a major upward review of pension for 2,116 retirees under the Nigerian Social Insurance Trust Fund, delivering one of the most significant pension adjustments in recent years. With the approval, total monthly pension payment for affected retirees have risen sharply from 12.56 million naira to 159.95 million naira, representing an unprecedented 1,173% increase in aggregate monthly payout. The adjustment brings long overdue relief to pensioners whose benefits had remained stagnant for more than 2 decades. The review, approved by the Director General of PENCON, Omolola Oloraran, aligns with the federal government's broader policy direction on improving the welfare of retirees and restoring the real value of pension benefits in line with current economic reality and statutory provisions. Notably, this marks the first pension increase for NSITF retirees in 21 years, addressing long-standing disparity within the scheme. In addition to higher monthly payment, the 2,116 retirees have received a total of 8.70 billion naira in pension arrears, with average arrears estimated at about 3 million naira per beneficiary. The impact of the adjustment is evident at the individual level. In one case, a retiree's monthly pension increased from 18,000 naira to over 206,000 naira, alongside the payment of more than 8 million naira in accumulated arrears. The pension enhancement was made possible by steady growth of the NSITF fund, which expanded from 54 billion naira at the point of transfer in 2005 to 195 billion naira as of December 2025. PENCOM attributed this growth to prudent fund management and strict regulatory oversight, which created the financial headrooms needed to implement the long-delayed review while maintaining the scheme's sustainability. The NSITF, established in 1993 as the successor to the National Provident Fund, managed pension benefits for private sector employees before the introduction of the Contributory Pension Scheme under the Pension Reform Act 2004. Following the reform, assets of the defunct NSITF scheme were transferred to Trust Fund Pension Limited, which was mandated to manage the fund and administer benefits to existing and deferred pensioners under Section 39(3) of the Pension Reform Act 2014 and Section 173(3) of the Constitution. Pensions are required to be reviewed at least every 5 years or in line with federal civil service salary adjustment. In addition, the NSITF benefits payment policy stipulates the minimum retirement pension must not fall below 80% of prevailing national minimum wage. The NSITF pension adjustment represents a landmark correction of long-standing inequities that erodes retirees' purchasing power for over 2 decades, while the scale of the increase in striking its sustainability hinges on continued prudent fund management and regular statutory review to prevent future backlog. If sustained, the move could strengthen confidence in Nigerian pension system and reinforce retirement security for private sector workers. The Nigerian Upstream Petroleum Regulatory Commission has opened bidding for 50 oil and gas blocks across 5 sedimentary basins under the 2025 licensing rounds, unveiling a significantly reduced signature bonus aimed at attracting fresh investment into the upstream sector. Under the new framework, signature bonuses have been slashed to between $3 million and $7 million per block, down from $10 million in 2024 licensing round, and a sharp contrast to the nearly $200 million required in early years. The revised pricing structure has received presidential approval. The development was announced by the Chief Executive of NUPRC, Orisheyiwa Esanya, during the 2025 licensing round pre-bid webinar held on January 28, 2026, where the Commission outlined the bid framework, evaluation criteria, and commercial terms guiding the process. A total of 50 assets are offered in the delayed 2025 licensing round, comprising 15 onshore blocks, 19 shallow water assets, 15 frontier basin blocks, and 1 deeper blocks. The broad spread is designed to give investors access to Nigeria's key hydrocarbon basin while supporting long-term reserve growth. The Commission explained that the revised commercial structure was deliberately designed to lower entry barriers, discourage speculative bidding, and place greater emphasis on technical competence, credible work programs, financial strength, and the ability to bring assets to production within the shortest possible time. The move reflects growing competition for global upstream capital and Nigeria's renewed push to position itself as a competitive destination for serious long-term oil and gas investors. By reducing upfront costs, the regulator aims to shift focus away from signature bonuses towards sustainable development, early production, and value creation. The NUPRC also assured investors of a stable and predictable regulatory environment, stressing that the 2025 licensing round is being conducted within a clear, transparent framework aligned with the global best practice. The exercise is expected to serve as a strategic intervention to boost reserve reserves, improve production level, and strengthen Nigerian energy security amid changing global energy dynamics. Selection of winning bidders will follow a strict merit-based process, with only companies demonstrating strong technical capability, sound financial capacity, and credible development plans expected to advance. The licensing round will run through a five-stage process covering registration and pre-qualification, data acquisition, technical bid submission, evaluation, and a commercial bid conference. The Commission confirmed that the entire process will comply full with the Petroleum Industry Act 2021, with duty to deploy to enhance transparency, ensure public accountability, and allow oversight by the institution such as the Nigerian Extractive Industry Transparency Initiative. All licensing materials have been available on the NUPRC portal since December 1, 2025, supported by dedicated channels for investors' engagement. The sharp reduction in signature bonuses marks a strategic shift by the NUPRC from revenue-heavy entry fee to investment-led growth by lowering upfront cost and prioritizing technical and financial capacity. Nigeria is positioning its upstream sector to attract more serious investors and accelerate asset development and boost production, though success will ultimately depend on regulatory consistency and timely project execution. Nigerian Naira has broken through the 1,400 Naira per dollar threshold on the official market for the first time in more than a year, crossing a key psychological and market milestone amid improving foreign exchange conditions. Latest data from the Central Bank of Nigeria shows that the foreign exchange market rate strengthened to 1,396.99 Naira per dollar on Thursday, up from 1,400.48 Naira the previous day. The move confirms the Naira returned below 1,400 marks after spending months trading above the level. Intraday trading reflected growing momentum for the local currency. The Naira traded as strong as 1,367 Naira per litre as weak as 1,400 Naira before closing at 1,385 Naira per dollar, extending a steady appreciation trend recorded through the week. Earlier in the period, the currency had traded a weaker level, hitting 1,422 Naira on January 22 and 1,421 Naira on January 23, before gradually strengthening to 1,418 Naira on Monday and 1,401 Naira on Tuesday. The latest movement below 1,400 therefore represents a clear movement in official market pricing and investors' sentiment. The positive trend was also mirrored in the parallel market, where the Naira appreciated further. Market data indicates a gain of about 1.06%, with the currency trading around 1,454 Naira per dollar. This reflects improving confidence across both the regulated official markets and the informal segments. The narrowing gap between official and parallel market rates has also become more pronounced. Analysts note that the premium of the parallel market over the official rate has compressed to about 6 to 7%, a sharp contrast to the wide disparity recorded in previous year. The spread, which stood at 64% in 2022, has now narrowed significantly, pointing to better price discovery and improved FX market alignment. Financial analysts had earlier projected that the Naira could trade within a more predictable range with this week, driven largely by foreign exchange supply and liquidity condition in the official market. Thursday's performance reinforced the outlook, extending the currency positive strength across multiple market segments. Analysis shows that the Naira break below 1,400 Naira per dollar is a strong psychological signal of improving FX market stability, while the appreciation reflects better liquidity and narrowing market distortion. Sustaining the moment will depend on consistent FX supply, disciplined monetary policy, and continued confidence from investors and exporters. The Nigerian exchange closed on a positive note on Thursday, January 29, 2026, as improved investor sentiment lifted key market indicators, even though trading activity slowed. Total market capitalization rose by 232 billion naira to 105.97 trillion naira, up from 105.74 trillion naira recorded in the previous session. The all-share index also advanced by 362.93 points to close at 165,527.31 points, representing a 0.22% gain. Despite the market's upward movement, trading activities declined. About 550.4 million shares worth 14.14 billion naira were traded in 38,635 deals, reflecting decline in volumes, turnover, and number of transactions compared with the previous session. Market breadth closed positive, with 41 stocks gaining and 27 recording losses, indicating selective buying across sectors. RT Briscoe led the gainers, rising by 10% to close at 7.15 naira per share. It was followed by Square Nigeria, Deep Capital Management, and Trust, and Veritas Capital Assurance, all posting strong price appreciation. On losing side, Andel MC Call recorded the steepest decline, shedding nearly 10%, alongside losses in Union Daikon Salt, University Press, and Legend Internet. In terms of activities, Veritas Capital Assurance topped the volume chart, followed by Guaranty Trust Holdings, Tantalizers, and J. Paul Gold and Ventures. Analysis shows that the modest rise in market capitalization reflects cautious optimism among investors following recent sell-off. However, the decline in trading volume suggests that many market participants remain selective, await clearer economic and corporate earning signals before committing fresh capital. All right, this is where we'll call it a wrap on Business Point today. Join me again next time on Global Television Channel 365 on DSTV and 276 on Star Times. To stay connected, kindly follow us on all our social media platforms using @GlobalTVNG. Till I come your way again, I am Kike Lomo Ukeri. I celebrate you all.